Hey folks, good morning. It is Memorial Day. We're going to go over a trade that we just took off the table a couple of weeks ago, which is DPST. First, I want to say happy Memorial Day and thank you to all of our veterans out there. Thank you for all that you've done. It's very selfless work that you've volunteered to do. You weren't asked to do it. You volunteered to do it. Thank you very much. So right now, it's very early in the morning. If you hear birds, I'm in the backyard. I'm on the deck. I have people that stayed over yesterday. We were in the pool all day. It was a beautiful day. They'll be up soon. I'm going to go to the gym in a little while to burn off all the margaritas that I had yesterday and will have today, and then we'll be back in the pool. So let's do a quick review of our trade of the DPST, which is the Direxion Leveraged ETF bank ETF. It's a regional bank ETF. So not so exposed to trading as they are to margins, okay? A margin is being made on loans. So you need to worry about interest rates, and if interest rates fall, that hurts the margins for the regional banks in particular because that's where their money's made. That's their bread and butter, is on loans. So we'll talk about the whys we got into the trade. We'll talk about specifics as to why we got into DPST, why we opened our position, why we added to that position, and why we closed that position. First, let's talk about the whys. Why did we like the long side of the market? Well, before we even talk about the DPST, we need to take a look at the macro view. And the macro view is what was the SP 500 doing at that point in time when we opened up our trade on the 23rd of April. Let's take a look at the SP 500. We'll come back to this chart because we need to know the whys first before we go into the DPST trade. Okay, so this is a chart of the SP 500. So we want to know what the market is going to do first, right? Because 80% or more of all stocks will trade with the SP 500. So to have an edge over other traders, we want to make sure that if we get long of the DPST or whatever we're looking to trade, that the SP 500 is going to go in that general direction as well. That increases our odds, our probability of making money. So here is the 23rd of April. So we had the DPST, which broke out on that day. So did the SP 500. That validated our thesis that in all probability we were going to make new highs on the S&P 500. We were not as heavy to the long side as I wanted to be, so we opened up a position in the banks, which had been underperforming. Now, the S&P 500 did in fact break out. We'll come back to this chart. But now we want to talk about why else we like the DPST, and then we'll segue into why we had to get out. So what else we were looking at was the XLF. This is the tracking ETF of the banking sector. So while you have regionals in here as well as the money center banks, it's a proxy for as to whether or not the banks are going to rally or will they underperform. So here you have it. On the 23rd of April, we flashed a bullish key reversal. So now let's think about it. We have the S&P 500, which broke out of a bull flag setup. We have the banks as represented on the XLF, which is the entire banking sphere. It flashed a bullish key reversal. So what was the market telling us? That was telling us in all probability the banks were going to break out, that DPST was going to break out and trade with the market. Now going back to a daily chart of the DPST, you could see that here on the 23rd again. This is the date we've been referencing, identifying very strong price action on the S&P 500 and on the XLF. And you could see that on the 23rd, we had a huge long white candlestick on the DPST. Normally, I would not open up a position into or very close to resistance, but the probability of the market breaking out was very strong, and so was a continuation move higher on the XLF. So we took some risk here, and we bought before the breakout, and it actually paid off because here on the 26th of April, we did break out, and we added more at $49 per share. So we had a breakout above this resistance level, which had acted as resistance for quite some time. Now, where things got a little bit concerning for me was when I took a look at the chart of the DPST on TrendSpider, which is the other charting software that I like to use. Let's take a look at it. All right, so here's TrendSpider. Here's where we opened our position on the 23rd of April. Then we added more here on the 26th on a breakout. And you can see that we were setting up for a nice uptrend channel. So really good stuff. So what I did was I said, you know what, let's identify on a weekly basis where we have historical support on this daily chart. It's called multi-time frame analysis. And I brought up, all you do here is click a button. And you can see in dashed line, that is a weekly view of resistance on TrendSpider. And then if you click on the D, it'll overlay in solid line the daily resistance levels. So you had a lot of resistance above, and then when you bring up your heat map, things get a little bit more disturbing. And you can see that there's an incredible amount of congestion up where this heat map implies that there's a lot of congestion, right? There's a lot of resistance above there. You have prior buyers looking to get made whole. That's called overhead supply. So keeping that in mind, that isn't necessarily a sell signal. Resistance levels are made to get broken through, right, ultimately. But when you go back and you take a look at the SP 500, had broken out on the 29th of April and had in fact closed above resistance. So we had a breakout. The problem was here, was on the 1st of May, that breakout failed. We were rejected, and this is what you call a breakout point failure. This is the market sending you a signal that all was not well with the S&P 500, and we could quite possibly have a macro double top on the S&P 500. And now when you think about the chart of DPST, we'll go to that chart now. So here you have it, daily chart DPST. When you take a look at the DPST, we were nowhere near the prior highs on the DPST or on the XLF. So therefore, the DPST, the banks were laggards versus the S&P 500. So if the S&P 500 broke down, what do you think is going to happen to the DPST? Right? It's going to get crushed, which in fact it ultimately did. Yes, we did rally after we stopped out. We stopped out here on the 1st. We did get a move higher, and in fact a higher high versus the highs of the 29th. Folks, you need to take the clues of the market. Sure, can you sit there and lick your wounds and say, wow, I got stopped out? You got to revisit why you got stopped out. Was your thesis accurate? Now, yes, if you look at the chart, you could say, Bob, it looks as though you had a retest of the breakout point, which you're always professing, watch for that. That's a good thing. And technically, that's an accurate statement. However, when you have the S&P 500, which just failed a breakout and flashed a breakout point failure or a bull trap, folks, you don't want to toy with the underlying market, because in all probability, the rest of the market's going to trade with the S&P 500. And yes, we bounced back off of a retest of support, but it didn't last long. So, and this is a problem that a lot of traders make, is that they get stopped out of a trade for all the right reasons. However, they have the FOMO, fear of missing out, and they'll jump back into the trade anticipating that the shares will go higher and that they made the wrong decision. You need to write down why you got stopped out of the trade to begin with, and you need to know when you're going to get out before you get into the trade anyway. And when you think about getting back involved with the stock, you need to revisit the whys of why you got stopped out to begin with, and ask yourself this question: has anything changed? Is the S&P 500 now breaking out to new all-time highs? The answer was no. It was breaking down. Now also, when you take a look at a chart of the 10-year yield, going into May, we were rallying on the 10-year yield, which is good for the banks because their net interest margins expand. They make more money on their loan portfolio. That all changed here. The week of April the 22nd, we had broken out the prior week, but the next week we flashed an outside reversal week, or a bearish engulfing of the prior week's move, very bearish stuff. The probability of a continuation breakdown was high. What does that mean for the overall economy? Something's wrong, right? It could be good for the stock market in the short term for the right reasons if you have strong economic data. But the economic data of late has been mixed at best. Yeah, the trade war with China, which was really getting ramped up at that point in time, so the headline risk was growing, yields were rolling over, NIM for the regional banks was tightening. The SP 500 just had a failed breakout. So do I want to risk having a profit turn into a loss? No way. It was first out, best out. We stopped out of the trade, and thank goodness that we did. Had we hoped when we should fear, let's take a look at where we would be right now. Now, here's where we had stopped out on the 1st of May. We did pull back. We put in a new daily low the following day, and then we rallied. And this is where people get caught. You know, they get stopped out for all the right reasons again. However, they think they're going to miss the boat, FOMO, they go jumping back into a trade. What would have happened had we not stopped out, or had we decided, you know what, we're going to second guess ourselves, we're going to go chasing the stock back up, despite the fact the SP 500 was rolling over? Well, we would have 2 days later been testing the lower band of support. On the 3rd day, we would have broken it. The 4th day, we broke the 20-period moving average, and a couple of weeks later now, we have retested the lower band. This is a daily chart, so in dashed line is weekly support. We retested it, consolidated, lots of topping action, bearish reversal bars, and Thursday last, we broke down below weekly support. On Friday, we closed down below weekly support. In all probability, we are going to make new lower lows here. Now, if we recapture weekly support and the S&P 500 begins to find some footing, well, then maybe we'll get long at a significantly lower price than where we stopped out. Now, had we not feared and taken the cues of the market, rather than sitting with a, granted, a 6 cent, 7 cent profit, it's not much, we would have been sitting with several dollars per share worth of losses, and I wouldn't be enjoying my weekend right now, because it's not the money. It's the fact that the market sent us signals and we didn't act upon them. So I always like to say, trade the charts, not the story. Have faith in your analysis of the markets. Know where to look and have confidence. It's as simple as that. And that's it. I hope you get some value out of this video. Enjoy your Memorial Day, and everybody have a great trading week. Members, I will talk to you tomorrow. Be well.